Hi guys, welcome back to the November update of my dividend growth portfolio. In this portfolio, I currently have 136,000 euros split between 21 stocks and 4 ETFs. But last month was pretty brutal. Big tech had a pretty hard time. One of my small caps cratered by 70%, and I am asking myself, why did this happen? Was it a market rotation or a miscalculation from my part? But here's the thing. Setbacks don't define you. How you react does. So let's go over everything that happened last month, what I plan on doing next, and how the stock scoring system that I built can help me with it. Because real investing isn't pretty every month. Real investing can be a grind that only rewards you if you stick with it long term. And by the way, if you're new here, my name is Florian. Thank you for joining me today. At the start of November, my portfolio had 141,000 euros split between 32,000 in ETFs and almost 109,000 euros in stocks. And after some strong month before, last month was pretty weak unfortunately. My total portfolio declined by 2.1% to now 138,442 euros. My stocks were affected even more than my ETFs, partially due to one company that declined by over 60% in total. I am actually recording this on Friday the 28th around noon. So, strictly speaking, there is still half a trading day left in Europe. But I don't think that this half day will affect my performance too much anymore. So I hope that you forgive me for missing this half day. When we take a more detailed look into my positions and sort it by monthly performance, we see that there is actually quite a large performance gap between the stocks that went good, like Alphabet, that is up by almost 23%, and the stocks that went bad, led by Surgical Science Sweden that crashed by 65%, and Meta that is still down by almost 15%. But I was not alone with this, and there was a general shift towards more defensive segments all over the market. While more risky segments like big tech and consumer cyclical are deep in the red, the defensive ones like healthcare and consumer defense had a pretty good month. Interestingly enough, the financial sector in general also had a hard time last month. And with the concentration that we currently have in the major indices, this was also visible there. The European Stock 600 in green, that is not so focused on tech, had the best performance, while the Nasdaq here in pink had by far the worst. The S&P 500 and the MSCI World have performed somewhere between these two and are also roughly on par with a slightly negative performance. But when we zoom out and look at the performance since the beginning of the year, the picture changes. In this time frame, the Nasdaq is still the strongest index, with the European Stock 600 being the worst. The MSCI World is also still slightly ahead of the S&P 500. But as always, despite the tough month, I still kept dollar cost averaging and, as announced in my plans last month, bought 2 more shares of Ferrari for 690 euros. This has brought my Ferrari position to 1,674 euros now. But this is still quite a bit below my target position size of around 4,000 to 5,000 euro that I would like to have here, so I will still keep it on my buy list for the next month, at least as long as the stock is still reasonably cheap. These new buys are also the reason why the stock appears on top of my monthly performance. This is not because the price of the stock appreciated very much, but because I increased my position by buying more shares. But Ferrari is not the most important stock this month. Unfortunately, as you just saw, there are some other stocks that deserve my immediate attention. And the first and most important one is Surgical Science Sweden that I actually also had on my buy list in the last month. But thankfully, there were other stocks even higher on the list and I never got to increase my position with them. In hindsight, this was pretty lucky because just 3 days ago, the stock crashed by almost 70% after some pretty devastating news. Intuitive Surgical, the biggest customer of Surgical Science Sweden, just cancelled their agreement to use Surgical Science simulation software for all DaVinci 5 robots. They will still use it for some high-end systems and they are still working together on simulation software for training. But this means that the vast majority of Intuitive's DaVinci 5 will be delivered without the software of Surgical Science Sweden, which will have a huge impact on their financial targets for 2026. Since this huge crash, the stock has recovered a little bit already, but this changes my investment thesis nonetheless. And while I still think that the company is active in a very interesting market, the immediate future and market position is far less certain for me now. The cancellation of this deal might also indicate that the market position of Surgical Science is far less strong than I thought before, or at least that the cooperation between Surgical Science and Intuitive is not as strong as I thought. I mean, I think that the current crash is a bit overdone. But I also think that this change will affect the growth potential at least for the next couple of years. So essentially, I have two options now. The first one is to stick with them and wait for the stock to come back, maybe even increase my position with them as I actually planned in the last month. Or the second one is to sell them. So I am essentially in the same position as with my second worst performer, Energiekontor, that I discussed in my last portfolio update already. The big difference between both companies is that with Energiekontor, it was a shift of project sales that caused the crash. In the case of Surgical Science Sweden, it was an outright cancellation. So while I still have hopes that Energiekontor can sell these projects next year and with it recover their stock price, at the moment at least, I am not seeing the same short-term potential for Surgical Science. What is also interesting is that these two companies that are also my worst performing stocks are my only two small caps. That means that they are pretty risky, but also that their volatility is quite high because the trading volume is much lower than for large caps. So even small news or changes in outlook could have a big impact on the stock price. This perfectly shows the risk that comes with these smaller companies. But I still believe that small caps are important and should be included in a diversified portfolio. But maybe I should work on my selection process for them. And a good starting point might be my stock scoring system. Because as promised in my last update, I entered all the numbers for all of my position and compared the scores. This is actually not the first time I've done this, but the first time I put them into the latest version of my system, the one with the dashboard that I also show here on YouTube. And look at that! Both Surgical Science Sweden and Energiekontor are in the last two positions in the 5-year score. Even in the 10-year score, they are last and third to last. I mean, Deutsche Post and Ahold Delhaize are also ranked rather low on my list here, but in their case I honestly don't expect too much. I see them more as my defensive plays that I keep in my portfolio as stability anchor, because a large part of their overall performance comes from their dividend payments. In case of DHL, the current yield is 4.3% and in Ahold Delhaize's case 3.2%. And both of them also have a decent long-term dividend growth, although in the case of DHL it did come down in the last 3 years. But still, my thesis for these two stocks is a bit different, especially when compared against Surgical Science. On the other end of the list, we have TSMC that gets the best score and is also the only company here that gets a higher than 8 score for 5 and 10 years. In a 10-year time frame, only Novo Nordisk has an even better score than TSMC. All of my big techs, Nvidia, Microsoft, Google and Meta are also ranked quite highly. But when I include the companies that I don't own but that I have also rated recently, Broadcom as well as Altria of all stocks appear pretty high on the list. And while Broadcom seems to have the higher potential in the short term, Altria can even beat them with their 10-year score. The European utility company Engie that I made a video about recently is also ranked pretty high. So this might even be a good alternative to Energiekontor. They are paying an even higher dividend yield of 8.2% right now, but their dividend is expected to decline a bit in the next years. But the stock had a pretty good run this year already, and especially in the last 2 months, while at the same time the growth outlook for them in the next 2 years is rather weak. So while I like the company in general, I think that it's not the best time to buy the stock right now. For completeness sake, I also want to mention that I did not rate VG and JP Morgan with my system, because it's not intended to be used for REITs and banks. So it doesn't make much sense to rate these two companies here. Utility companies such as Engie or Energiekontor should also be treated a bit carefully, because some of the metrics can't be directly compared to regular companies. so we should also take their score with a grain of salt, at least when we compare them to non-utilities. But also when we directly compare ENGIE and Energiekontor, ENGIE comes out on top by far. What stands out most here is actually the dividend score, where ENGIE has a much higher score than Energiekontor. This comes from the dividend cut that Energiekontor had earlier this year. But still, my predicament stays. While ENGIE had a good run and I don't see any short-term catalyst for the next 2 years, I still think that Energiekontor stock could recover very quickly if the company manages to sell the delayed projects. And by the way, even though Energiekontor is a utility company, I don't see them as a defensive play or stability anchor in my portfolio because they are still a highly volatile small cap. And while they are steadily increasing the wind and solar parks that they own, and with it the revenue from power sales, a large portion of their revenue still comes from project sales. One thing that I'm currently looking into is selling some of these stocks at a loss to use it for tax loss harvesting and offset some of the taxes on the profits that I have to pay if I want to rebalance my Nvidia position, for example. And this doesn't even mean that I'd have to fully close a position, because I could just rebuy the same position pretty much immediately and basically just realize the current losses without removing the position from my portfolio. This may sound a bit strange and I have never done this so far. But so far, the dividend payments I received and the profits I realized have always been below the tax-free limit we have here in Germany. This year though, the dividend payments alone are breaking this tax-free limit already. And speaking of dividends, this month I received my first dividend payment of 7.30 euros from Danaher on the 3rd of November. On the same day, JP Morgan also paid the dividend of 34.23 euros. Next came ASML on the 6th of November with 9.52 euro, while Texas Instruments paid the highest dividend last month with 37.34 euro on the 13th of November. So in total, I received 88.39 euros of dividends in November. This has brought the total dividends in the current quarter to almost 200 euros and just 5 euros below the dividends I received for the whole quarter last year. And with 1 month still to go, I think that I can handily beat last year's payments. When we look at the whole year so far, I am already around 20% above the level that I got last year in total. So I am already pretty curious to see where I end up this year compared to last year. All in all, my portfolio now looks like this. Nvidia's portion has shrunk a bit together with their stock price, same as Microsoft. The crash of Surgical Science Sweden has decreased this position to only 1% of my total portfolio now. This was already my second smallest position after Ferrari, but I just started the Ferrari position last month. And between Surgical Science crash and the second Ferrari batch that I bought, this is now reversed. From the big techs that I own, only Google could grow so much that it now makes up 6% of my position instead of 5% last month. This is also a fairly new position that I just entered in July and further increased in September. And it is already up by over 50% in total performance. So I got pretty lucky with my timing here. And yes, I could blow my own horn of how clever this was and how well I timed it. But let's be real. You also need a bit of luck when it comes to investing, and you can't time everything. In the end, nobody can see into the future. For next month, I still have pretty much the same stocks on my buy list as last month. Well, except for Surgical Science, of course. But I'm also planning to potentially rebalance my portfolio depending on how December goes. And if I decide to do this, I will also sell some stocks at a loss to compensate for the profits that I realize in this case, as I explained before. And I also want to revisit my 3 predictions for my top stocks for 2025 from the beginning of the year and see how my predictions turned out. What I don't have in my short-term plans right here is that I'll of course also keep on working on my stock scoring system. Right now, I am actually working on an automatic data import with API so that I don't have to enter all the data manually. I've also started to look into Markov chains to backtest and in the end improve my algorithm further. But this will definitely still take some time to be implemented. If you are interested in how I approach this and maybe make some more detailed updates in the future, please let me know down in the comments. Up to now, I am still a bit hesitant because, well, it's a lot of statistics, math, and trying out stuff. So I am not sure how interesting this is to see. What I still have absolutely planned though is a video where I explain the current system in more detail. But this video will take a bit more preparation than I initially thought, and I am very sorry, but I just don't have the time to do this right now. I still have this on my to-do list for early next year. Probably it will come in February or latest March. And guys, if you're interested in a stock that had 20 times the performance of the S&P 500 over the last 10 years and is currently the top pick in its category from Seeking Alpha's quant system, this video right here might be interesting for you. And as always, this is no financial advice, so please do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.